As you grow older, there are a lot of things that become dependent on you. Your parents are dependent on you for supporting them in their old age. Your spouse and children are dependent on you for emotional and financial support. In the unfortunate scenario, if anything happens to you, your family's loss will never be able to cover by any means. However, they won't be burdened with financial stress at least if you have a life insurance. Life insurance is a product in which your family or nominee will get a certain amount of money that was part of your contract with life insurance company. This amount is called sum assured in technical terms. In this video, we will understand more about various aspects of life insurance. A life insurance policy can be of three types: a term insurance, an endowment policy, and whole life insurance. Let's see what these mean. Term insurance is an insurance policy that will have a defined term. For example, if you are 30 years old and you take 40 years of term plan, then your life will be insured only till the age of 70. If you die before the age of 70, your family or nominee will get whatever is the sum insured. If you live beyond the age of 70, nobody gets anything. In this case, you have to pay premium till you are 70 or till your death. On the other hand, whole life insurance is a policy under which your life will be insured as long as you are alive and you are paying the premium. In this case, your family or nominee will get the sum insured after your death at any point in time. There is no limit to the age like term insurance. Endowment policy is an interesting concept. In India, people were skeptical about paying premiums for term insurance or whole life insurance because they get nothing in return if they cross the age limit in case of term insurance or until they are alive in the case of whole life insurance. Hence, insurance companies introduce a product in which the person who is paying the insurance premium will get something in return if he completes the term. There are various types of offers that the insurance companies have created. The premium return policy is one of the classic examples of the endowment policy. Under this policy, an insured will get back all the premiums he has paid if he survives till the end of the contract. Another classical example under which you have to pay a premium for 5 years and then after that you will get some money back for 15 years. These numbers can change from policy to policy, but the basic concept is that you have to pay premium for some time and then you get back money after that for some period. You must be thinking, what a great scheme. Pay the premium, secure your loved ones and get back money if you survive. But remember my friends, there is no free lunch in this world. The premiums of endowment policy are very high as compared to term insurance. I will tell you why. When you pay a premium for an endowment plan, a part of it is taken for your life insurance coverage as if it's a term plan. And the remaining part is invested in the market, and when you survive, the money is given from this investment only. It's not the case that insurance companies give back money from their own pocket. They take it from you only, invest it and give it back. Moreover, they charge the investment management fees separately, which is often very high. And most importantly, since the returns by insurance companies are guaranteed in nature, they can't invest this money in products that do not provide guaranteed returns. So, that leaves them no option but to invest their money in government bonds whose returns are safest and guaranteed. So, if you actually calculate the returns you get on endowment policy, then the returns are around the returns of fixed deposit or sometimes even less than that. I give investment management fees if all they are going to give is an FD return. Instead, what you can do is buy the term insurance plan, invest the difference between the premium of the endowment policy and the term policy on your own. You can choose the investment products suitable for you based on your goals and risk appetite. Let's understand how much life insurance coverage you should have. Insurance companies provide a range of cover from as low as rupees 2 lakh to hundreds of crores. There are certain factors that you should consider while deciding on life insurance coverage. The first one is your income and expense. In the unfortunate scenario of your death, your family should be able to cover their expenses for at least 10 to 15 years. So, the insurance coverage should be at least 10 to 15 times of your annual income or annual expenses. The second is your existing debt or loans. If you die, your lenders have all the rights to recover the loan taken by you from your family. So, to avoid forcing your family to go into debt traps, insurance coverage should also be able to cover your loan amounts. The third point is money required for important things in your family's life, like your child's education expenses. In case of your death, your children should not be left without education. And the last point is that if you have any realizable assets now, then that amount should be deducted from the total of the previous 3 points. Of course, every individual will have a different situation in their life, which may affect the insurance coverage amount apart from the previously mentioned points. Well, there are some more points that are not being covered as of now, like what should be the duration of your policy, what happens if you want to discontinue the policy, and a couple of more points. I'll cover those points in a separate video. Until then, enjoy learning more about other types of policies.